Hello, everybody. This is PC from GlobalAlphaS. I'm back with you with the usual monthly update. I'm sorry for a slight delay this month, but I just had no optionality earlier to come back with an update to you. So I'm doing it today so that you have an overview of what has been happening with the portfolio and on the markets during November. Let's get to it. I will present you my screen. 1 second. Okay, we can kick off. The S&P was up almost 6% last month. Gold was up almost 9% last month, and long-term treasuries represented by the Tilt ETF were up approximately 8%. On average, this adds up to our synthetic internal benchmark having been up around 7% versus our portfolio up 5.9% during the month of November. So we actually underperformed a little bit versus the synthetic internal benchmark, and we outperformed a tiny little bit versus the S&P 500 itself. On a year-to-date basis, we're down 7% right now, so we do outperform substantially both the equity benchmark by approximately 8 percentage point, and the synthetic internal benchmark by approximately 9 percentage point. The equity allocation did not change much from the month before. We're still at around 71% equity allocation, including equity ETFs. We have approximately 20% cash in the portfolio right now, and a little holding in the gold represented by the GLD ETF, but our current weighing in gold is below our cycle-adjusted benchmark, which is currently at 20%. Risk stays very stable at around 4, maximum at 5, but on average it's around 4. The major reshuffles that we have done during the month were adding some Google, Skyworks, and some Microsoft. So some of the very well valued stocks with a lot of free cash flows, a lot of good balance sheet characteristics. So they include value and growth characteristics, which we are looking for, and are very fairly valued at current levels. We had a little in and out trade in Tilt, but it was nothing substantial, and our holdings in gold did not really change. We have underperformed versus the SIB, as I have already said, and we outperformed. Sorry, there's a mistake here. We outperformed a tiny little bit versus the S&P 500. Major market drivers during November. We saw a continuation of improving inflation trends. Generally, the readings were finally hitting below expectations, and that's exactly what the market has been waiting for, and that allowed for a big rally in the equities over the last month. The Fed got what it wanted. The markets started pricing in a more dovish Powell from here, and we finally got a nod from Mr. Powell on the 30th of November during his speech, when he said that eventually the Fed will start slowing down the rates of increases of the Fed funds going forward. The swaps pricing in a lower than previously expected terminal rate at slightly below 5% right now. The yield curve remains negative in general, but that's a very widely known situation right now. The yields are generally lower, dollar is generally weaker, and the equities, especially growth equities, are generally buoyed by the macro setup with a weaker dollar and lower yields. The quantitative tightening is continuing as planned, and the Fed continues to decrease their balance sheet in a very stable manner. They have already managed to come down to at around 8.4 trillion dollars in terms of total assets. This is in line with what they have already pre-announced a couple of quarters ago already. Weaker macro is in place with unemployment ticking tiny little bit higher. depressed consumer and housing markets. The China zero COVID policy is about to ease, and we've had a couple of confirmations from the Middle Kingdom during the month of November in terms of them generally trying to drive the economy out of the zero COVID policy. This has obviously supported equities in general, especially Chinese markets and general emerging markets. Gold becomes an alternative finally with yields falling. Gold, as you may obviously know, is a non-yielding asset. So the higher the yields for treasuries, the less of an appeal gold has versus such an asset like the treasuries. The bonds did rally hard. That was obviously in line with what the market was starting to price in, so a more dovish Fed going forward. In terms of the Fed overview, we usually make a month-on-month change report. We highlight the changes, but this month the major thing to watch was basically the speech Mr. Powell had on the 30th of November at the end of the month, which, as many market participants said, was a quasi pivot and was very applauded by the markets. And here it's a citation from Mr. Powell highlighted in yellow. He said basically that it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down, and also the time for moderating the pace of rate increases may come as soon as December meeting. So he basically highlighted what the market was waiting for, giving equity investors hope for a less hawkish Fed in December onwards. A quick look at the US inflation tendencies in November. We've got 11 out of 18 major inflation goals lower than last month, and 5 additional ones kind of flat on month-on-month basis. So many inflation readings are now confirming that inflation is indeed slowing, especially the headline inflation. There's obviously an increased talk and dispute about the sticky part of inflation, which is the services part, that is kind of lagging the PPI part, and the less sticky one in terms of the goods inflation, right? So the services inflation is basically more sticky, the goods inflation is less sticky, and the latter one is already kind of ahead of the first one, as it usually happens. But now the market is trying to figure out whether the more sticky one will follow the less sticky one, which is mostly making the headlines. The forecast and expectations, not much changed in terms of where we are in the phase right now. We're still in the boom phase. Our major coincident indicators from the enhanced aggregate spread model by Dr. Robert Daly from No Spill Forecast are as follows. Private payrolls are up year on year by 4% right now. Industrial production is still up 3.3% on year-on-year basis, and the delta is up 3.4%, but the S&P is down right now, so we're kind of in the boom phase in terms of this coincident indicator. My conclusions: the boom phase continues to develop. There is no cycle peak expected over the 9-month forecast period that the enhanced aggregate spread model foresees. My end October expectations of lower yields, less hawkish Fed, and well-bid equity markets fully materialized, and we obviously did manage to increase our year-on-year returns, being above the benchmark with approximately 70% equity allocation versus 50% benchmark allocation for the boom phase of the economic cycle that we have assumed. I plan to stay overweight equities in December as I continue to expect higher markets and falling volatility. Last couple of days, as I'm recording this presentation today, have been a little bit weaker, but still I am expecting at least some kind of end-year rally into the end of December. December seasonality is supportive for equities, and I continue to prefer value, but well-priced growth stocks are also part of equity exposure, as I have already showed you before. I have added some Google, some Keywords, and some Microsoft, which are partially growth stocks as well. I wanted to show you a couple of more little graphs from Mr. Iardeni, whom, as you know, I take a lot of data, as I think he's doing a lot of great job in terms of showing very nicely the macroeconomic data as they follow, especially for the US market. So inflation and slowdown eats into corporate margins. That's what I wanted to show you, but it's expected to subside in 2024 as inflation comes back under control. As you can see here, highlighted in yellow, right now the average profit margin, operating profit margin, has fallen from 13.5% slightly to potentially closer to 12.5% in 2023. But as the year unfolds next year, the expectations for the next year, for 2024, so for the following year, are back higher, above 13%. So the market is basically expecting the inflation to keep subsiding and the general macro situation keep normalizing as we kind of unwind through 2023. The S&P 500 earnings recession is expected in the first quarter and in the second quarter of next year. What you can see here is the market consensus and Iardeni research expectations for 2023 and 2024 S&P 500 EPS. And as you can very well see, highlighted in yellow again, first quarter and the second quarter are going to be the ones that will most possibly show year-on-year fall in terms of EPS, with an expectation for the third and the fourth quarter to positive again, and the EPS starting to grow again. So we're ahead of a period in the first quarter next year where it's going to be possibly bumpy, it's going to be a bit touchy, and the situation is going to be a little bit unstable. It will obviously all depend on eventually on the attitude of the Fed against the inflation fight, in terms of what are the eventual consequences for the economy are going to be. But I think for now, the market is pricing in very well an earnings recession. I'm not talking about a macroeconomic recession right now in terms of GDP falling at least 2 quarters on a quarter-to-quarter basis, but I'm talking about earnings recession. And this is well priced in now, given the recent performance of equities. I think S&P 500 has generally made the bottom for this drawdown starting at the start of this year. The stocks will remain bumpy in the first and second quarter most possibly, but I think many investors will already start positioning into better times in the second half of 2023 and onwards. This is it for this month. Sorry, it was a great month in November. I wish you all the best for Christmas, and I hear you in a month. If you would think about copying me, the minimum suggested copy amount is $500. Please do always remember that the longer you copy, the better the long-term returns. Our portfolio is a long-term portfolio expected to grow over the whole economic cycle, which is usually a couple of years. And please always be patient and resilient through turbulences. Thank you very much. I'll see you in a month. Bye.